Hey, what's up, stock compounders? Brad here. So today I want to do a Q&A session. All right, we've got 5 questions to cover today. 4 are actually from you guys. I only had to pull 1 from the value investing Facebook group. So let's get into it. Question 1, what is your opinion on investing in different countries like India or China? There's a couple things I like that Monish Pabrai has said about this. So when you're dealing with emerging countries like India and China, you got to be more careful with issues like fraud. Okay, when Pabrai invests out of the U.S., typically he's going and visiting management. He needs to try to size up management and make sure that they have integrity and that they're competent. It can be hard to get, company filings and things like that outside of the U.S. In certain situations. So when he invests outside of the U.S., he's visiting management. He doesn't do that when he invests in companies within the U.S. So that's a big difference, considering investing in places like India and China. The flip side, there's a lot more great opportunities outside of the U.S. In companies like India and China that are growing much more quickly than the U.S. is. There's a lot more 10 and 100 baggers in countries like that. So that's a big reason why Monish Pabrai has spent a lot more time outside of the U.S. in recent years. It's just been a lot harder to find great investments in the U.S. I think the number of public companies in the U.S. has shrunk by quite a bit in the last decade. So that's something to consider. Just make sure you really understand the business and management before you make an investment outside of the U.S. Question 2, what are you reading to gain knowledge about investment ideas? So, I don't read newspapers regularly. I don't subscribe to Wall Street Journal or any of those regular newspapers that a lot of value investors read. And I don't really read things consistently. Usually what happens is there's an investment idea that I get excited about. And then I read the annual report, I read the quarterly reports for that company. Sometimes I'll read Motley Fool articles about it. I'll read what people are saying at the corner of Berkshire and Fairfax message board. I'll read the Value Investors Club write-ups. So I'll really do a deep dive on that particular company. Lately I've been reading books from Phil Town. I've been reading The Acquirer's Multiple. I think it's Tobias Carlyle who wrote that. And there's one more. I read Joel Greenblatt's latest book, which I did a video on, called Common Sense. So I try to read kind of the best investment books that have come out recently and stay on top of that. But there's nothing I really read regularly. It tends to be the investment that pulls me in, and then I read things that are relevant to that particular investment idea. Question 3, how much time do you spend per day in the learning zone? So this is also very highly variable. I've been spending a lot of time making YouTube videos in the last 4 or 5 months. So in terms of being in the learning zone, it tends to be batched. Like I said for the last question, where I'll get kind of obsessive about a particular investment opportunity, and I'll just consume a lot of research and information about that particular company in a short amount of time. So it's not like I don't have so much of a routine around becoming a better investor in terms of reading things regularly or even spending, a similar amount of time each day doing that kind of thing. It's highly variable. But I probably spend, on average, which again, average isn't a very good indicator, but a couple of hours a day in the learning zone, so to speak. Question 4, what are the major factors when deciding to invest in a company for dividends, right? So, you're really drawn to the company because of the dividends. What do you look for to make sure that it's going to be a good investment? Well, the same thing you would look for if you were just investing for capital gains, for stock price appreciation. One, you want to make sure you have some sense of what the future cash flows are going to be, so you can know what the value of a share of stock is. Okay, you got to be able to value the business with some degree of comfort that you're not going to be way off. Okay, so that's the first thing, or at least not way off to the downside. Okay, it's fine if you're way off to the upside, but you want to have a reasonable sense of how much you stand to lose in this particular investment. Okay, so that's one. Can you value the business? 2, is management competent? Is management skilled to be able to grow that business over time? Hopefully it's an investment that you're buying because you want to be a partial owner of the business, right? You're buying because you believe in the business. So you need to know if the management has the skill to be able to grow that business, okay? You also need to know how the management team is incentivized, right? Are they incentivized to distribute the benefits of that business, the future cash flows of that business to shareholders, or do they have other incentives? So you really want to understand it's best if the majority of compensation that the management receives is through stocks, because then when stockholders benefit, they also benefit. That's aligned incentives. So how is management compensated would be a third question. And then a fourth factor, is there a margin of safety? Which goes back to the beginning question. Can you value the business? And then this last piece is the price significantly below the value of that business? To give you a margin of safety, so that if the business unfolds in a way that you don't expect, can you still make money? If there's a big enough margin of safety, you can still make money, even if there are missteps that happen as the business goes along. So those are the 4 major factors I would look at if you're looking at investing in a company for dividends, the same as if you're looking to invest just to have the stock price appreciate. And those are really guidelines from Warren Buffett. So, fantastic guidelines to follow. Question 5, how diversified should a portfolio be? Charlie Munger says if you really understand 3 businesses and you understand how to value those businesses and understand how to project the future cash flows of those businesses, you understand how to evaluate management. If you really understand 3 businesses, that's enough, okay? I'm a little bit more conservative than that. I would say anywhere from 5 to 10. If you really understand those businesses and you understand how to evaluate them through the eyes of an investor, I think 5 to 10 is enough. But the less you understand about the businesses, the less capable you are of understanding the business, understanding the investment thesis, all of the factors that go into understanding, how that investment is likely to play out over time. The less you understand about those things, the more stocks you should own, the more businesses you should own. So there's kind of a, what do you call that? A continuum there where the more you know, the less you have to own, and the less you know, the more you should own. And, you know, it's okay if you don't know that much. If you know nothing, you can still do quite well as an investor, but you have to own up to the fact that you don't know anything and just invest in a diversified index fund like the S&P 500. And that's what Warren Buffett recommends for most people, okay? Most people don't have the skills, don't have the knowledge, don't have the experience to beat the market by picking individual stocks, and that's perfectly fine. The problem comes when people think that they can beat the market, when they don't actually have the skills to do so. That's why a lot of investors underperform the market, because they're more confident than they should be. And I think Charlie Munger threw out a stat, something like 90% of investors think that they're smarter than the average investor, which obviously isn't true. So you gotta keep your ego in check in this game, and kind of know where you are. And if you can't do better than average, be average. Okay. Actually, you're going to be better than average if you just buy the S&P 500 index, because there's a lot of people who think they'll do better than average, and that's not actually true. So that's the most important thing. Know thyself. Super important in the game of investing. So those are the 5 questions I wanted to tackle. Let me know, what questions you have that that you want me to tackle next weekend. Happy to do that. It's much more fun for me to tackle the questions that you guys have, as opposed to, just going on to the value investing Facebook group or, other people's Q&A, so that I have enough material to fill out these sessions. So ask away, guys, and I will see you in the next video. Take care.